Hello, everyone. My name is Connor O'Brien, and I am a portfolio manager here at Legacy Private Trust. The purpose of today's video is to quickly provide color on some of the asset allocation updates the Legacy investment team has implemented over the last few months. I will run through a quick economic and market overview, and that's really meant to provide justification for our asset allocation decisions. We'll talk about a few important economic data points here in the US, provide a brief recap on Q3 earnings, and talk about where we sit from a valuation perspective heading into the end of the year. And then we'll get to the point of the call, and that is to address the tactical shift that we have made in our client portfolios and walk through the details of the timing of that decision. So when it comes to the economy, specifically here in the US, it's difficult to find economic data that isn't at all-time highs. Home prices are at all-time highs. GDP is back well above pre-pandemic levels. US retail sales have continued to blow away expectations, and household net worth sits at $134 trillion as of the end of October. That's just here in the US. And remember, that's just assets minus liabilities. It's net worth. And it's important to remember that big $134 trillion number in the context of federal deficit levels. We hear all the time about the big, scary $29–30 trillion federal deficit, and that's certainly not something we should be all that excited about, but you also have to consider the asset side of the equation. And not only does our country and economy have significant resources, but the US consumer does as well. We also can't forget about the rapid recovery in the labor market. Unemployment is down to 4.6% after hitting 15% last spring. We have 10 million job openings here in the US, the most of all time. And we also have more people quitting their job than ever before. And that's something that only happens when people are confident in the economy. You also have wages, salaries, and average hourly earnings at all-time highs, especially for low-income workers, which is a great thing. And COVID has also been a boon for entrepreneurship. We've seen business applications skyrocket over the last 18 months. Not only is the economy in the US in great shape, but corporate America continues to blow away expectations as well. Earnings per share are well above pre-pandemic levels and are projected to grow 45% this year. Revenues are also at all-time highs. And this is important because the bottom line, or earnings, can be massaged, where revenue is revenue. And that highlights just the massive pent-up demand coming out of COVID. And last but not least, profitability is at all-time highs. The narrative this earnings season has been that higher inflationary input costs will squeeze the bottom line. And that's just not happened. Corporate America and small and medium-sized businesses have been successful in passing along price increases, which has pushed profitability back to all-time highs. And last but not least, when it comes to valuations, we've seen the B word get thrown around a lot over the last decade and really over the last year. And by that, I mean bubble. And there are certainly pockets of froth and bubbly activity. But when it comes to the S&P 500, the last year has been a time period where earnings growth has actually outpaced the market. Since last November, the markets are up just shy of 30%. That's the green line there that you see. That's the total return of the S&P 500 going back 1 year. However, during the same time, earnings in purple are up 35%. So that what that means is that the markets have actually gotten cheaper and less expensive over the last 12 months. The blue line there at the bottom is the PE ratio of the S&P 500, a common metric for valuation. And while price, the P, has certainly gone up quite a bit, the E has gone up even more. And it's nice to be able to say that valuations have actually shrunk over the last year. So based on everything I've said thus far, I'm sure it won't come as a surprise that we are optimistic. And optimistic about the economy, optimistic about the consumer, and optimistic about corporate America. And when you look at client accounts at Legacy, every portfolio has a targeted equity exposure. And that target is based on how aggressive the account is. However, based on our market assumptions and expectations, we have the ability to tactically shift our asset allocations within a range. And because of our optimism, we do recommend that equity exposure in our client accounts is at or near the top of that range for equities, and therefore the fixed income exposure in client accounts will be near the bottom of that range. So you may have noticed shifts in your portfolio that reflect this update. These changes were made over the last several months. When you look at the long run, the factors that most closely correlate with market returns are the fundamentals of corporate America, profitability. However, over the short run, market sentiment, or how people feel about stocks, can be a great timing tool. When sentiment turns significantly less bullish, as it did in September and October, that's the green line that you see there, assuming that earnings are still growing and the economy is still expanding, that is usually a great opportunity. And sentiment turned significantly in September and October. Inflation data heated up. We had our first big, scary 5% market correction. People got scared. But the overall market narrative, solid economic data, great earnings, strong consumer, none of that changed. So we looked at that as an opportunity to go overweight equities. Since then, the markets have reversed and we're back to new all-time highs as I speak right now. If you would like any more information on this or Legacy Private Trust, please visit our website, lptrust.com, or contact marketing@lptrust.com. As a reminder, we will be closed Thursday, November 25th for Thanksgiving. And on behalf of Legacy, I would like to wish everyone a happy Thanksgiving, an enjoyable holiday season, and a great rest of your 2021.